most of you will know what swaps are, but just to complete the circle on this, swap is basically something which you can do to protect your floating rate payments, floating rate loans, and convert them into a fixed rate. Okay, so most of the loans are overnight compounded SOFR, right? Typically, or a term SOFR. So SOFR plus spread converted to fixed. That's a swap. So the bank will give you a fixed rate for all the future SOFR floating rates, and you can therefore be safe from any future fluctuations. There are some companies where they will say, okay, I don't want to, or even you can think about it that way, where, if I have a 5-year loan or a 7-year loan, I will directly do the entire hedging of the loan using a swap, a 5-year swap or a 7-year swap. Based on the market rate, you will get a particular quote. Now, the another option is, instead of doing, let's say, 5-year to 7-year, if you have a view that, the next 1 year, whatever markets are projecting and whatever my view is are matching. So there's no point in hedging for now. Okay, the way floating rates are so far is going to behave in the next 1 year is same as what market is also saying. So there's no point in hedging. If that is your view, you might choose to say, okay, but then 2 to 3 years or 2 to 4 years period, I think market is probably underestimating or so on the potential rates. So let me lock in there or something like that. So you can actually do individual floating rate payments. You can lock in into a fixed rate. That is called FRA. A FRA, or a forward rate agreement, is basically an individual. Each payment can be hedged separately. Generally, people don't do it in the company corporate sector. This is more in the banks that they trade on this, but you can do it. But you can think of a swap as a series of FRAs, meaning every payment there is a particular fixed rate that the market is giving, and all of them put together is a swap rate or an average of the floating rate payments in the next 5 years or 7 years, depending on the tenor you are looking for. So a swap enables you to hedge. Now, hedge the floating rate into fixed rate, and this is an interest rate swap. So right now in the SOFR market, so if you have a ECB SOFR plus 2%, if you go and do a, let's say, a 5-year hedge, you might get, let's say, 350 or 360 kind of a rate for SOFR. So you can lock in your loan at 560 fixed for all the payments in the future. So this is one way of managing your interest rate risk, a swap, interest rate swap. One small thing which probably I will highlight, on the swaps part, is that, when you go for hedging in swap market, we have to make sure that the swap terms and the terms for the loan are matching. So for example, if your loan has a day count frequency for your interest payments as actual by 360, you should match that in the swap to make sure everything is matching. If you have a overnight compounded SOFR every quarter, you have to make sure that the swap matches it. But if you have a term SOFR, actually, some of the banks are not willing to quote term SOFR. So if you have a term SOFR based loan, then you have some issues, but there are ways to manage it, using a SOFR benchmark in the swap, which is reflecting roughly the same term SOFR levels. These are the aspects that we have to keep in mind. What is the day count convention? What is the frequency of payment? What is the holiday convention? So these things make a huge difference in your hedging. Also, calendar, holiday calendar, all of these are important, because especially for accounting, for large companies, typically they go for hedge accounting. In such a case, these things become very important. So there are interest rate swaps. Basically, there are interest rate swaps in all markets, but from Indian companies' perspective, interest rate swaps are not only the ultimate hedge, right? Because you also have a currency to hedge. Currency, basically hedging through a swap is basically possible because India also has an interest rate swap market called MIFOR, right? Now, like you have a SOFR-based market in the US, you have India. In India, there's something called MIFOR swap market. So using MIFOR and the interest rate swap in the US, people come up with hedging for ECBs, right? So if you want to hedge only the interest and you don't want to hedge any principal or any foreign currency risk, then you can do interest rate swap. But if you want to hedge the entire principal and interest rate risk of a loan, then you can do what is called a cross currency swap or a CCS. But you want to hedge only the principal risk, but you don't want to touch the interest rate risk or when I say interest rate risk, I'm talking about the SOFR risk or the currency risk on the interest rate payments, only the principal repayment risk I want to hedge. Then you go for a principal only swap or a POS. But if you want to hedge, don't want to hedge the principal into rupee, but want to hedge only the interest payments fully, meaning the SOFR risk also is hedged. The FX risk on the principal is also hedged. Then you have a swap called a COS or a coupon only swap. So you have a COS, coupon only swap, only coupons are hedged. You have a POS where only principal is hedged, and you combine both of them, both the coupons and principal are hedged fully. It's called a cross currency swap. So these swaps are priced using MIFAR swap in the Indian market and the dollar swap rate in the US market. They combine these two and price when you have a specific ECB or a specific loan that you are looking to price. So these are all the swaps that we have to keep in mind in terms of the actual hedging that you're looking for.